Strength is showing up in places that it should be soft. Growth was revised higher in spring. New orders are rebounding. Claims for unemployment dropped back towards summer lows. So recession? Where? Because we don't see one in sight. This data is looking pretty good. Yet for the third straight session, stocks slipped lower as traders reassessed how much good news is already baked into the price, already priced in. So that's what we'll talk about tonight. I'll map the gap between resilient data and a market that just blinked through it. So the government's final read on second quarter GDP landed at 3.8%, which is not too shabby. It's a notable jump from the previous 3.3% estimate and the initial 3% that was published back in July. This was the strongest quarterly growth in nearly 2 years, and that upgrade came from two engines driving it. The first being that consumers spent more than initially thought on services, think like restaurants, healthcare, insurance, transportation, the things that are the core that drives U.S. output. The second is that business investment completely accelerated with intellectual property, R&D, and software rising at a 15% annual rate, which is the quickest since 1999. Now, that's the kind of line item economists flag as a tailwind for future productivity, so hey, it might get better from here. There's also a new window into the infrastructure behind the AI build out. For the first time, the Commerce Department broke out a data center structures line. So companies spent at a 40.4 billion annual rate in Q2, more than 4 times the pace from early 2020. And these numbers by themselves won't swing GDP one way or another, but they quantify the power demand and capital intensity behind the AI wave. As RSM's Joe Brusuelis puts it, this is part of the rich mosaic of Americans' growth that keeps attracting global investment. A note from on the quarterly mechanics, Q1 was revised to this 0.6% rate as firms front-loaded imports ahead of tariffs. This is old news. We already knew that, which then set up Q2 for a rebound as imports dropped back. And that trade arithmetic helped amplify the 3.8% print that we got today, which was pretty good. But even with that good news, even with stronger macro backdrop that we're seeing, equities fell yet again. Today we've seen the Dow fall 0.38%, the S&P 500 fall 0.5%. We've seen the NASDAQ match the S&P and fall 0.5%. We've seen Bitcoin fall down to my line, and you see it right there. It's really hugging it. You see TLT kind of trying to hug my line a little bit. I might be off a little bit. But the streets take is that resilient growth and AI supercharged CapEx cycle and this soft landing narrative have already powered a series of record highs in recent weeks. And with so much of that baked in and priced into the markets, the tape is sensitive to any counterpoint that might point otherwise away from that bull run narrative that a lot of people want. And you saw that tug of war in real time today. The solid data on GDP, we'll get into the jobless claims and durable goods, which were on one side of the good data that we got today. And then you got this valuation nerve with stocks being pretty high or expensive valuation wise and sector specific stress that we'll also get into on the other side. So as one portfolio manager put it, each day feels like this tug of war between this AI momentum on one side and then concerns about inflation and jobs on the other, which, do you blame anybody? So outside of AI, autos, that auto market, mainly the used auto market, flashed yellow. Halt, y'all, halt! So tariffs have been squeezing margins up and down the supply chain for quite a while, and a subprime auto lender collapsed recently, and retailers are signaling consumer fatigue on these bigger ticket items. And then today's hit. This is the big one right here. CarMax said sales and profits plunged last quarter, leading the stock to fall 20% today. Back to the 2020 pandemic lows, and that's the kind of single name move that challenges the everything's fine narrative. And the economy can run above trend while specific pockets, interest rate sensitive and tariff exposed, absorb the pressure. But for how long? Now, with all of this mess going on, like, man, stocks are expensive, there's this and that and all these problems coming up, but then we got this good economic data, like, which way are we going? And something I wanted to point out is that while all of this moving pieces are existing right now, there are other things that have allowed stocks to climb so long. So zooming out, I wanted to talk about this. So strategists have a long list on why US equities have marched higher since 2008, which was the last real big financial crisis before the pandemic, of course. Profit margins that the biggest companies have expanded while earnings volatility has fell. Floating rate debt has been largely eliminated from the S&P 500 balance sheets. The rise of big tech, think like Microsoft, Apple, some of those others in the Magnificent Seven, and even the NASDAQ 100 or even the S&P 500, they've all reshaped global profits. But then there's a structural force that often gets missed. So Michael C., I'm not even going to try to slaughter this man's last name, at JP Morgan urges that declining net equity supply since 2011, think like buybacks and fewer new shares, has quietly boosted resilience. So if supply and demand set prices for goods and labor, they can also set the price of financial assets. And that scarcity narrative helps explain why shocks have been absorbed with less volatility than history might suggest. So, supply chains, everybody. Supply and demand has been driving stocks higher since 2008. Just think about that. It's kind of counterintuitive if you, honestly, if you really, really think about it. But let's get back into some of this more positive data we got today. So this is more on the factory side where tariffs remain a thorn, but the latest orders data showed real momentum, which was positive. Headline durable goods increased by 2.9% in August, juiced by aircrafts. Commercial planes up 22%, military aircrafts up 50%. If you strip out transportation, you still get an increase of 0.4%. And the signal piece, core capital goods orders increased by 0.6% on the month, running 4% year over year, which was a second straight strong gain. It's looking good in the hood. Now, what's really pushing it is tech, computers, softwares, technology. Orders for that bucket are up 12% year over year, even after a brief pause back in August. Two tailwinds do sit underneath, though. You got new federal tax breaks for investment and a corporate scramble to weave AI into workflows. Meanwhile, more traditional manufactured goods, which are the ones most tariff exposed, are still sluggish. The mix says a lot about how the economy is adapting. You got weakness where costs are sticky, strength where productivity upside is completely obvious. Some more good news we got today was jobless claims, which weekly claims cooled nerves that layoffs were picking up. We didn't see a real big increase in these jobless claims. Instead, they fell. So they fell to 218,000, which is the lowest since about mid-July, versus expectations for a rise to 235,000. The 2 week swing is pretty meaningful if you look at it, if you kind of zoom out. Claims spiked to 264,000 earlier in this month, which was a nearly 4-year high, then dropped by 46,000. Now, under the hood, unadjusted filings fell by 14,822 to about 180,611, which was a 2-year low. And then continuing claims edged down to 1.93 million. It's still been in that same little wheelhouse that it's been. But while hiring has slowed and it's taken longer to land new roles, there's no evidence of this sudden layoff wave. As high frequency economics puts it, this refutes the layoff surge narrative and undercuts calls for bigger or faster rate cuts, at least for right now. And then you had Starbucks announcing that they were going to close some stores and about 900 jobs were going to be lost from that. I think it was Starbucks. You might fact check me. But that strength meets a central bank that's still trying to balance inflation above target with softer hiring backdrop that we've been in, and two voting members lean cautious on adding additional near-term easing regarding cuts. So we had Jeff Schmid, the a Fed president out in Kansas City, I believe. And he's saying that policy is in the right place right now, with inflation still being too high for his comfort. And the labor market is largely in balance, at least from his point of view. And looking at the jobless claims data, which they say jobless claims don't spike until you're already in a recession, but who knows? Then Austin Goolsbee out in Chicago. He's uneasy with front loading too many cuts. He wants clear disinflation after 5 years of being above target. And then Vice Chair Michael Barr urged focus on the path next year, not just between now and December. He wants us to look next year. So base case is to reduce rates over time, but to do it carefully so tariff-related price increases don't get embedded and cause this inflation shock. And with that tone and the firm data, odds on an October quarter point cut have eased. And on the CME Fed Watch tool, I was looking at it yesterday, it was above 90, and right now it's sitting at 85.5. It dropped as low as even around like 82 or even 80%. And the odds of staying steady and not cutting at this October 29th meeting rose up to almost 15%. But that's just one, or I guess a few different perspectives. But there's that one dissenter out there. So on the other side, Stephen Miran, that guy is urging for rapid easing. So rates are 1.5 to 2 percentage points too high and holding their risks material increases in unemployment. So he's really watching the labor market. He thinks there's going to be this spike in unemployment if rates don't drop. So he's supporting cuts. And his neutral rate sits at the mid 2% range. So that's quite a bit lower than where we're at. And he says that because of tighter borders and higher tariff revenues, he's okay with that. And Miran links population swings directly to shelter inflation, with negative net migration increasing the effective supply of housing. He expects shelter inflation to cool within 6 to 12 months. He also separates financial conditions buoyancy from monetary stance, attributing elevated assets more to tax cuts and deregulation than Federal Reserve policy. And that framework keeps the debate over Fed independence in view. So I guess he's doing good, and this was right as Lisa Cook was urging for Federal Reserve's independence away from Trump and being fiscally, because the government does fiscal policy, the Fed does monetary policy. Fiscal views. Next on the Fed's calendar is, and this is coming up as early as tomorrow, is the Fed's preferred inflation gauge. So this is what everybody's going to be watching tomorrow. So if we go to the economic calendar, we got a busy packed schedule tomorrow, but the main one is the PCE, the personal consumptions expenditures. The last read was 0.2%. We're expecting it to rise. Actually, oh, wait. We're expecting it to fall because we like watching the core PCE, which strips out the volatile segments like food and energy costs. So this would be the read for August. We were on a core reading at 3%. Now we're expecting to fall to 2%. Who knows if we actually come in there or not, but in either way, inflation is still above the 2% long-run goal, but it hasn't risen much as as feared from the tariffs. And one reason could be the rate cuts were delayed earlier this year while officials assessed pass-through. They wanted to see how that was going to impact. They wanted the clouds and the dust to kind of settle through as all of this tariff uncertainty was going. But the risk lens is now about composition. We got goods versus services. Goods prices, which are most sensitive to tariffs, are up about 0.5% year over year after outright declines through much of 2023 and 2024. And services cooled earlier this year, then perked up back in June and July, which is a red flag from the Fed because the Fed doesn't want that, and they're going to test against that in August. So we'll keep on watching. Vanguard's take is that the tariff-related inflation should be gradual and manageable, with companies having less wiggle room to raise prices than in the immediate post-pandemic period. Now, markets will be scanning the details for any hints that service stickiness lingers, because the services that really moves the needle. would validate a careful cuts camp. Now, a hotter services print would bolster any of the skip October argument, but we'll keep on watching that. We really want cool PCE if we really want those cut arguments to continue. Then we also got a lot of Tom barking together, consumer sentiment. Michelle Bowman will be speaking. But anyways, to put it all together, everybody, this was a longer video so far. We're running, like 15 minutes, 10 seconds right now. Growth revised higher to 3.8% with consumer services and IP investment in the lead. CapEx, so core orders rising. AI-linked technology is up 12% year over year. Claims for jobless claims are back down to 218,000, which is a 2-week drop of 46,000. Markets are 3 days down in the red, even as this good news meets full pricing, with autos highlighting real economy friction. Policy, we got Fed voices turning more cautious as there's all these moving pieces out there, and odds of an October cut slipped to 85.5%. But Miran, that man, he's still pressing for faster moves. So the story in a Friday is pretty simple. An economy that refuses to roll over, a market that already banked that resilience, and a central bank calibrating how quickly to ease without reigniting prices. GDP says momentum, claims say stability, orders say investment is real. Now, PCE will be what decides how much patience the Fed can afford on the way down. I'll have the full breakdown right after the release tomorrow sometime. Be on the lookout for it. Thanks for hanging out with me, everybody. Hope your night is awesome. And sounds like somebody just showed up at my house. I'll go get the door.